At New River, we specialise in UK retail real estate, both investment and asset management. Today, our portfolio includes over 70 retail assets from across the UK. So our scale, retailer relations and access to extensive market data puts us in a unique position to understand UK retail real estate, both the risks and the opportunities. Retail real estate is a highly dynamic sector, one that has evolved rapidly, but it's had its fair share of challenges over the past decade. However, the story today is fundamentally different, and importantly, it's a story supported by data, not sentiment. I want to take you on a very honest tour of the UK retail market, where the sector has come from, where we stand now, and where the evidence tells us we're heading. This is based on data as at the end of January 2026. So let's begin where all good stories start, with the protagonist, the consumer. If you want to understand retail, you start with the person walking into the store. And despite the noise out there, the consumer enters 2026 in remarkably good shape. Real wages have been growing for 2 years. Unemployment remains low. Savings still elevated at over 146 billion of excess savings give households real resilience. Housing hasn't cracked. Prices remain 25% above pre-COVID. Residential rental growth is still high but slowing, and inflation is stabilizing. So before we talk about retail real estate, it's worth stating clearly the consumer backdrop is far healthier than the headlines would suggest, and that takes us naturally to how people feel. Confidence, as we all know, drives behavior. And here's where the story gets even more interesting. Consumers are more positive about their personal finances than they were a year ago, and they're even more optimistic about the year ahead. Now, they're still skeptical about the economy, but people don't make spending decisions based on the OBR forecast. They make them based on whether they feel secure. And that shift, that psychological turning point, is now feeding directly into spending. Which brings us to what's happening in the tills. Retail spending is growing, up 5% year on year, and not just in essentials. Discretionary categories are strong too. Leisure, hobbies, home-related spend are all doing well. Almost half of all consumer spend now sits across retail and supermarkets, followed by household bills and mortgages, both of which are growing in terms of cost. So yes, cost pressures are real, but the spending engine is still turning, and in key segments accelerating. And the strongest litmus test of all, Christmas. Christmas quarter rarely disappoints, and 2025 was no exception. Despite the autumn budget casting a long shadow, Christmas delivered 2.8% growth. Food retail performed well and fashion held up. Christmas is retail's litmus test, and once again, it confirmed the underlying resilience of the consumer and the critical role of physical retail. And speaking of structural truths, I must of course now talk about online. For years we heard the same narrative. Online will keep rising, physical retail will keep shrinking. That narrative has finished. Online penetration has flatlined. Growth in online is decelerating sharply, and pure-play online operators are losing market share, squeezed by delivery costs, returns, and fragile economics. Meanwhile, omni-channel operators, those with strong physical store networks, are winning. The future isn't online versus offline, it's online and offline working together. Physical retail is once again central to brand strategy. And the retailers themselves? Well, they're adapting, and fast. Retailers have had plenty thrown at them. National insurance cost increases, wage pressures, energy volatility. But the pendulum is swinging back. Supply chain costs have come down, container shipping is far more manageable. Business rates multipliers are improving for most retail property groups. Retailers have responded with operational discipline, cost optimization, pricing strategy, productivity. This isn't the retail of 5 years ago. This is a leaner, smarter, and more efficient sector. And that transformation is feeding directly into the occupational market. Occupational demand continues to be strong and, importantly, selective. Retailers are opening stores, but they're opening them in the right places at the right rents. Covenant strength across the board is solid. The main vulnerabilities sit with pure play online operators, not bricks and mortar retail. And in retail warehousing, limited availability has created real opportunities for rental growth. All of which tells us one thing: physical retail is not shrinking, it's reshaping. And the next slide shows the impact of that reshaping. For the first time in years, retail is the only core property sector where vacancy has fallen for 2 consecutive years. Retail warehouses have delivered 4 years of sustained rental growth. Shopping centres, after a decade of pain, are now seeing rents grow again. The occupational market is the strongest it's been in over a decade. Supply is constrained, demand is increasing. Rents are moving up from a very rebased level. And when occupational markets improve, capital markets follow, which is exactly what we're seeing. Retail is now one of the top performing sectors on a total return basis, driven by high resilient income. Income returns are 150 to 250 basis points above other core sectors. Capital values after years of write-downs are stabilizing and beginning to grow. Look ahead 5 years and the forecast is even stronger. Retail warehouses and shopping centres are expected to be among the highest performing UK real estate segments. This is no longer a recovery story, it's a performance story, and investors are responding. In H1 2025, shopping centre investment was muted, mainly due to a lack of sellers, but demand was quietly building behind the scenes. In H2, that demand materialized, volumes surged, yields tightened, competitive bidding returned, especially for larger assets with strong income stories. Institutions are back, financing terms have improved, liquidity is rising. This is the busiest we've seen the shopping centre market since 2016. And retail warehouses? Well, they continue to do what they've done for years: deliver. Retail warehouses remain the most liquid and institutionally supported retail sector. 2.6 billion of transactions, yields compressing 25 to 50 basis points, and a strong, diverse buyer base, from private equity to pension funds to overseas capital. Supply is constrained, demand is robust, and rental growth prospects remain compelling. This is a segment with clear momentum, and investors are alive to this. These are the segments in which New River specializes. So let me pull all of this together. The consumer is strong, retail spending is growing, retailers are performing well, vacancy is falling, rents are rising, capital values are set to rise. Income returns are among the strongest in the UK real estate market, and liquidity is improving across the board. Retail real estate is not just back, it is structurally attractive and forecast to outperform. This is a very different story from the one told 5 years ago, and is backed by real measurable change across every level of the market.